Hello, and welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today's presentation is Essential Accounting Concepts, Episode 4. The concepts in this video come from my book, Is Your Business Idea a Good Investment? It's available on Amazon.com, Kindle version only. Go to the Amazon search bar, select books, type in my name, Jay Berman, scroll quickly to my book and purchase. And by doing so, you support my channel and my work in entrepreneurial business education. Thank you. So today's essential accounting concepts I'm going to cover involves the balance sheet, long-term assets, long-term liabilities, depreciation, and capital gain. And remember, when you are doing your balance sheet, that assets always equals liabilities plus owner's equity. And I highly recommend you learn either Microsoft Excel or Google. They're very similar spreadsheet programs, so you can calculate your own balance sheet. So long-term assets are assets that can be sold or converted into cash after 12 months. They're listed as book value, which is the original cost of the asset minus any depreciation. And I'll discuss depreciation very shortly. Long-term assets can be depreciation or expense over a number of years according to its accounting convention. Land is a long-term asset that cannot be depreciated. Most common depreciable long-term assets are buildings, real estate, such as apartments, hotels, stores, offices, homes, manufacturing machinery and equipment, vehicles, such as cars and trucks, and information technology, computers, hardware, software, those type of information technology items. So let me talk about depreciation and capital gain. So let's say, for example, you buy a truck for $50,000, whether it's new or used. In this particular example, it doesn't matter. You bought it for $50,000. That would be the book value, which is the original purchase price. And you would list the $50,000 as book value on your balance sheet under long-term assets. The accounting convention, the government allows you to depreciate the truck over a 5-year period. So in this case, you're able to depreciate the truck $10,000 a year over a 5-year period. So on your income statement, let's say, for example, you depreciate the truck in years 1, 2, 3, and 4, and you would do so under operating expenses on the income statement. So your balance sheet year 2, now the truck is worth $40,000. That would be the new book value, because after the first year you depreciated the truck for $10,000. So 50,000 minus 10,000 is 40,000. Year 3 is another $10,000. So now the book value is worth 30,000. Balance sheet year 4, now the truck is worth, the book value is worth $20,000. And then in year 5, now that you've depreciated over a 4-year period, so 50,000 minus 40,000, the book value is now 10,000. Again, just to keep the math simple. But let's say you decide to sell the truck. So now the truck is worth 10,000. Not only is it called the book value, it's also called the salvage value. And let's say somebody comes along and says, hey, I want to buy that truck for $20,000. And you say, yeah, great, I'll take it. So, but you do incur in capital gain. So you sell the truck for $20,000, but you still have $10,000 in book value or salvage value. So your capital gain would be $10,000. Then let's talk about long-term liabilities. These are items that a company owes another person or company that for over more than 12 months. The most common long-term liabilities would be loans, some sort of debt. A company lists the original principal and any outstanding debt. So let's say you have a loan for $100,000. You've already paid off $50,000. So 100,000 minus $50,000 would be $50,000. So your original principal is 100,000 and your outstanding debt is 50,000. And there are two types of debt. The first one is called secure debt. It's called secure debt because you have collateral supporting the value of that loan, such as real estate, cars. Probably the most common collateral type of secure debt that pretty much everybody is familiar with are mortgages. So when you buy a house, your house is the collateral. So if, God forbid, you don't pay your mortgage, the bank can foreclose on your house and they'll seize the house as collateral, sell the collateral so they can get their loan money, their mortgage paid off. The same thing with cars. If you run into financial trouble, you can't afford the car, the bank will repossess the car, sell the car in order to pay off the loan. So collateral kind of protects the bank when they loan money to you, and that's the purpose of collateral. Now, there is a thing called unsecured debt, where there is no collateral. Probably the best example would be credit cards. You don't pay your credit cards. The bank cannot seize any of your personal property. They can't seize your house. They can't seize your car, any valuables like jewelry, clothes, furniture. They can't do any of that. Of course, if you are running into problems paying off your credit cards, I recommend you contact the credit card companies to negotiate a lower interest rate, because with collateral loans, the interest rates are usually much lower than unsecured debt, because as you are familiar, credit cards, the interest rates can be pretty high, 25%. So if you are experiencing credit card payment issues, in other words, you can't pay your credit card, making credit card payments, you may want to contact the bank. They do have programs to help you lower the interest rate and make the payments a little bit more affordable. Now, when you do pay interest on your debts, whether it's secured and unsecured, and again, this is related to business, it would be considered interest payable. And I discussed this in episode 2, where that would be considered a current liability, because interest payable, excuse me, is considered a future interest payment. So you have to kind of set aside that money to make your interest payments. Interest paid, once you pay your interest, then that item is recorded on the income statement. And any principal that is paid, that is recorded on the statement of cash flows, which I will cover in a future episode. And that's all what I have for today. Any questions or comments, please use the comment section. Subscribe to my channel for more educational content about entrepreneurship. And I thank you for watching, and have a great day and be good. Thank you.